Does ARM merit this valuation? Let's start there.
I think if you buy into the AI hype, this is a company that is profitable. You got to give them credit. They have a business model that delivers 30 plus operating margins. But you need almost 40% growth and an increase in margin to about 40 to 45% to get to $50 or $55 per share. So is that plausible? Yes. This is a growing business. They have a chip design advantage that's going to work in their favor. Could I get to 55? Yes. But I think you're asking for a lot. You're pricing the company for incredible growth, which it might or might not be able to deliver.
Watch how ARM's business model evolves, given SoftBank owns 90% of the business. Can you expand on that, Aswath, since you have said you won't touch anything that SoftBank has touched?
I just don't trust SoftBank. It's not just the WeWork episode over the last decade. This is a company that goes into private businesses, often provides 6, 7, 8 of the 10 rounds of venture capital that the business gets. It reminds me of a guy who gets on eBay and bids against himself or herself, and over time pushes up the price, saying, look what I did to the price. So I tend to be skeptical about any company that comes to the market with a SoftBank-based pricing. That's not to say they're not going to strike it lucky once in a while. They did hit gold with ARM because they found a company that happened to be in the eye of the storm, the AI business, especially as AI is taking off. I don't think they expected that when they originally invested in the company, but sometimes it's good to be lucky rather than good.
Away from the AI buzz, let's talk about the Barbie buzz, because we've got an IPO coming up for Birkenstock. And, you know, Aswath, I'm not normally a Birkenstock kind of gal, but even I was oohing and ahhing over the beautiful pink Birkenstocks that Margot Robbie was wearing in the final scene of the Barbie movie. But is that enough? Is that enough for this company, which is essentially still just a footwear company?
This is a 250-year-old company. And 2 years ago, private equity investors, this is the peak of the market, they bought the company at $4.3 billion. They're now trying to take it to the market at twice that price. So I'm already asking, what did you do in 2 years that changed the company so much that it's doubled in value when the rest of the market is under pressure? Some of that is the Barbie bump, but that's not going to last. Some of it might be just redesigned to go after a larger market. But I think you're buying into a lot of hype with Birkenstock. I mean, I don't care how cool it is, what the brand name looks like. You know, you're already paying a premium. You're paying about 6 times revenues. And to pay 6 times revenues for a footwear company, you're building in the presumption that that coolness factor will never wear off. And there'll be other Barbies down the road bumping up the pricing.
So if we're talking about these 3 IPOs, there's ARM, which, as we mentioned, after its first day bump has been losing steam. Instacart, which really lost its early morning gains of 43%. And then you've got Birkenstock, which you are concerned about from a valuation perspective. What does this, in summary, tell us about whether or not risk capital is truly coming back to the markets?
At one level, the people pushing these companies are probably heaving a sigh of relief because there's a very real chance of catastrophe on these companies. That people wouldn't buy the stock price would drop 20 or 25%. In fact, if you look at the Instacart IPO, it was the most swaddled, risk-averse IPO I've ever seen. The pricing was set at a conservative number. You had 60% of the shares already lined up to sell to cornerstone investors. It's almost like people were ready for the disaster and they were happy it didn't happen. So I have a feeling it'll take a week or two for this to play out. But if the stock price stays above the offer price 2 weeks from now, I think these companies will all view this as, that as a win, because I think it's a sign that risk capital perhaps is creeping off the sidelines, but it's not running off the sidelines. So this isn't a rush to these companies, and that's something we need to build in when we think about what we think will happen to the market for the rest of the year.